Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at healthcare and my guest is Tyler Ellegard, Portfolio Manager at Gradient Investments. Guarding against sickness and death has, for the most part, always provided healthy returns for healthcare companies and their investors. And its non-cyclical nature means it held up well during the downturns in the big indices last year, as previously. Year to date, the S&P 500 healthcare index is up around 7% or so. That compares to around 12% for the S&P 500 as a whole. Among tailwinds for the sector have been a favourable funding environment under the Biden administration, and right now some argue that many stocks within it are undervalued. Equally, some big players could be overvalued, it said, while others have been struggling for a compelling narrative post-COVID. Well, with me is Tyler Ellegard of Gradient Investments. Welcome, Tyler. Many thanks for joining us today. Some of the big names in pharma, I'm thinking of Pfizer, have fallen out of favour somewhat. And some of the others in the sector, I'm thinking of Eli Lilly and Novo Nordisk, have huge valuations at the moment. Does that mean that there's a healthcare warning attached to some healthcare stocks?
So the shift has been from the big pharma names like the Pfizers, the AbbVies of the world, and to those main two players. But I think we're getting to a point where the pipelines for these other major pharma companies are getting to a healthy point now where their projected revenue going forward is high single digits, low double digits. And so you're starting to see the valuation of some of these obesity drugs get quite extended. Yes, they have significant growth, but you're getting to a point where is it worth the risk of paying those high premiums for the stocks when you can find discounts elsewhere for maybe a little bit less earnings growth, but still, a mid-teen to low single digit growth at a cheap valuation is something that is starting to look quite attractive to us.
So does what you just said, does that mean that we should start thinking rather differently about healthcare, that it's no longer simply a defensive non-cyclical play, but that there are pockets of real value to be had there?
Yes, your big pharmas are always going to be that true defensive nature, but you have other pockets of healthcare, whether it's contracted research organizations, CROs, medtech, diabetes care, those types of things. Those are areas that are significant growth factors right now, and it's probably not the traditional defensive play. But I think the other scenario now, and why we're getting more optimistic on healthcare is not only are valuations cheap, but we're also starting to get into that maybe late cycle of our economic story right now. You've got concerns over economic growth here in the US. You've got jobs coming down or job availability coming down, unemployment's trending higher, inflation is staying a little bit stickier than we initially thought it would. I think it's creating a pretty significant storm, if you will, to have a great opportunity in this sector right now.
And would you add in AI into that scenario of opportunity?
If we want to talk about AI, I really think the contract research organizations are really going to benefit from AI in helping with some of those preclinical and clinical trials going forward. So I do think there's going to be a benefit to AI at some point. I don't think the story is getting there just yet.
Well, one company that you do like in the context of the contract research organizations is IQVIA. Tell us about them.
The biotech funding over the last couple of years has been what I would call poor relative to the COVID years. The 2020, 2021s, we had a significant increase in funding for biotechs, which in turn leads to more money for preclinical and clinical trials, which is where IQVIA sits. So I think as we normalize this funding and you start to look at budgets for preclinical and clinical trials going forward, IQVIA is going to be the main market share for that.
So Tyler, let's look at medtech in that context. Dexcom is a name that crops up at Gradient Investments. I know you like them for their work with monitoring glucose equipment. Tell me a bit more about them.
What these companies have done, both Dexcom and you can even throw in Abbott here. Abbott just got approval for Lingo, their new monitor, but Dexcom just released Strelo, and that is going to open up the space for them, not only to just severe type 2 diabetics and type 1 diabetics, but it's going to open it up to less severe type 2 diabetics, and even the health conscious person who wants to monitor their glucose levels for to understand how food affects them going forward, how activity affects them, those types of things. And so it opens up their space to not only just diabetics, but it's going to open it up their story to a much larger addressable market for them. And it's going to provide them significant growth going forward. Yes, it could be slow at the outset as people kind of understand what these actually are, because again, Dexcom has been geared towards diabetic patients for their entire life, whereas now they're going to open that up. So I think the potential growth for them going forward with these new products is going to be quite significant in what I would call the next 2 to 3 years.
Tyler Ellegard, Portfolio Manager at Gradient Investments, many thanks for sharing your thoughts with us today. And that is your roundup of the healthcare sector. I'm David Pollard. This is Reuters.